Good morning. Today we're exploring a story that quietly shapes the world around us, even if you don't notice it every day. The US dollar, long considered the backbone of global finance, is experiencing a gentle but meaningful decline. This isn't a dramatic crash or a sudden crisis, but rather a subtle shift that ripples through economies, businesses, and households alike. Whether you're shopping for groceries, planning a vacation abroad, or simply watching prices rise at your local store, the value of the dollar touches your life in more ways than you might realize. A weaker dollar means imported goods can become more expensive, and international travel might cost you more. Even if you never leave your hometown, the effects can show up in your everyday expenses. Recently, the US dollar index slipped to its lowest point since early July, catching the attention of investors and economists worldwide. This index measures the dollar's strength against a basket of other major currencies, and its decline signals a shift in how global markets view the US economy's prospects. Investors are now betting that the era of a super strong dollar is taking a pause. They're closely watching the Federal Reserve, the central bank that sets the tone for US monetary policy, for any signs of change. The mood on trading floors and in boardrooms is shifting as everyone tries to anticipate the Fed's next move. The main driver behind this change? Expectations that the Federal Reserve will soon make borrowing cheaper by cutting interest rates. When the Fed lowers rates, it becomes less attractive for investors to hold dollars since they get less return on their money. Lower interest rates mean the dollar offers less reward to foreign investors, so demand for the currency drops. As demand falls, so does the dollar's value, making it less dominant on the world stage. This can have far-reaching effects, from international trade to the cost of borrowing for businesses and governments. But this isn't just a concern for traders or big corporations. It affects your credit card rates, the price of imported coffee at your favorite cafe, and even the cost of electronics and clothing. Everyday consumers feel the impact, sometimes in subtle ways, as the prices of goods and services adjust. Understanding this gentle decline is key to seeing the bigger economic picture. It helps explain why some prices are rising, why certain investments are shifting, and why policymakers are making the decisions they do. It's not a reason to panic, but it is a reason to stay informed and pay attention to how these changes might affect your financial plans. Being aware of these trends can help you make smarter choices, whether you're investing, saving, or just budgeting for your family. Over the next few minutes, we'll break down why this is happening, what the Federal Reserve is doing, and how it could impact your wallet, your savings, and your future plans. We'll also look at what experts are saying and what you can do to stay ahead. So, let's dive deeper into the Federal Reserve's role at the heart of this story and see how its decisions are shaping the value of the dollar and your financial world. All eyes are on the US Federal Reserve, which is expected to cut its key interest rate this week. This anticipated move is already shaking up markets and pushing the dollar lower. The expected cut is modest, just 0.25 percentage point, but even small changes can ripple through the economy. This rate influences borrowing costs for everything from mortgages to business loans. The Fed's decision signals a desire to make borrowing easier and stimulate growth. Beyond the cut, everyone will be listening to Fed Chair Jerome Powell's words for clues about future moves. If he hints at more cuts, the dollar could fall further. Investors are already adjusting their positions in anticipation, showing how markets often move on expectations, not just actions. The big question: will the Fed deliver what's expected or surprise the world? Either way, the global financial system is bracing for impact. Why is the Fed considering a rate cut now? It's a question on the minds of investors, business owners, and everyday Americans alike. The answer lies in the complex balancing act the Federal Reserve must perform to keep the economy healthy and resilient. It's all about keeping the economy on track. When signs of weakness appear, the Fed has to weigh its options carefully, aiming to support growth without letting inflation get out of hand. Recent data shows the U.S. job market is cooling after a period of strong growth. Fewer job openings and a slowdown in hiring suggest that businesses are becoming more cautious about the future. Fewer jobs and slower wage growth are red flags, suggesting businesses and consumers are becoming more cautious. When people worry about their jobs or paychecks, they tend to spend less, which can ripple through the entire economy. By cutting rates, the Fed hopes to encourage borrowing and investment, keeping the job market healthy. Lower rates make it easier for families to buy homes, for students to afford education, and for entrepreneurs to launch new ventures. This move acts as economic insurance, acting before a slowdown becomes a recession. It's about providing a cushion so that if the economy stumbles, it doesn't fall too far. The Fed often has to act on forecasts, not just past data, trying to steer the economy through uncertain waters. Predicting the future is never easy, but waiting too long can make problems harder to fix. Economic data can lag behind reality, so the Fed is looking ahead, not just reacting. By anticipating trouble, they can take steps to soften the blow before it hits. Their goal: give the economy a gentle nudge to maintain momentum. It's about keeping confidence high and making sure growth doesn't stall out. It's a balancing act. Stimulate growth without overheating. The Fed must weigh the risks of acting too soon against the dangers of waiting too long. Acting now could prevent bigger problems down the road. A timely rate cut can help stabilize markets and reassure both businesses and consumers. The Fed's proactive approach is about managing risk, not waiting for trouble to hit. By staying ahead of the curve, they aim to keep the economy strong, stable, and ready for whatever comes next. President Trump has added political pressure, publicly urging the Fed to cut rates more aggressively. He argues that a bigger cut would supercharge the economy and make the U.S. more competitive globally. The president's calls put the Fed in a tricky spot. It must balance its independent mandate with public demands from the White House. Trump often points to lower rates abroad, saying the U.S. needs to keep pace to help exporters. This frames the Fed's decision as both domestic policy and global strategy. Ultimately, the Fed's independence is crucial, but the political context can't be ignored. The tension between immediate growth and long-term stability is front and center. This dynamic will shape the backdrop for the Fed's big announcement. President Trump specifically highlighted the housing market as a key beneficiary of lower rates. When the Fed cuts rates, mortgage rates often follow, making home loans cheaper. Even a small drop can save homeowners thousands over the life of a loan and make monthly payments more affordable. Lower rates can boost home buying, spark demand for goods and services, and create jobs in construction and related industries. But there's a risk. Too much demand can push home prices higher, offsetting the benefits of lower rates. The Fed aims for a gentle boost, not a housing bubble. Stimulating the housing market can lift the broader economy, but it's a delicate balance. The goal is sustainable growth, not runaway prices. The value of the US dollar is never fixed. It's always measured against other major currencies around the world. Recently, the dollar has been on a downward trend, and this shift has given a boost to rivals like the euro, the British pound, and the Japanese yen. When the dollar weakens, it doesn't just affect Americans. It sends ripples through the entire global economy, changing the way people and businesses move money across borders. The euro, for example, has surged to its highest level against the dollar since early July. This rise reflects a growing sense of confidence among investors in the European economy, and it signals that money is flowing out of the US and into Europe as people look for better returns. The British pound and Australian dollar have also gained strength. For Americans, this means that traveling abroad or buying imported goods has become more expensive, as their dollars don't stretch as far as they did just a few months ago. International money managers and big investors are now shifting their funds out of dollar-based assets and into other currencies. This is largely because many expect US interest rates to fall soon, making dollar investments less attractive compared to those in other countries. Even the Japanese yen, which is often seen as a safe haven during times of uncertainty, has gained ground against the dollar. Investors are seeking stability and better opportunities elsewhere. These moves highlight how global investors react quickly to changing expectations about interest rates and economic growth. Every shift in policy or economic outlook can trigger a wave of money moving across borders. As the dollar weakens, other currencies naturally rise in value. It's a classic example of supply and demand in action, with investors constantly seeking the best returns for their money. This global rebalancing of currency values is a normal part of international finance. It's how markets adjust to new realities, whether it's changing interest rates, political events, or shifts in economic growth. Currency values are always in motion, constantly shifting in response to interest rates, inflation, and the overall economic outlook in each country. Traders and investors watch these changes closely, looking for opportunities and managing risks. The dollar's recent slide is directly causing a rise in other currencies as the world's financial system adjusts to what the Federal Reserve might do next. Every move by the Fed is watched closely, as it can shift the balance of power in global markets. It's a textbook example of just how interconnected and dynamic global finance really is, where every decision, every rate change, and every shift in confidence can have worldwide effects. While the Fed prepares to cut rates, the Bank of England is holding steady. Despite recent economic strain and slowing job growth, the UK's main concern is stubborn inflation. The Bank of England is keeping rates high to fight rising prices, even if it means slower growth. This tough balancing act is a classic central banking dilemma. The result? The British pound is strengthening against the dollar as investors favor higher UK rates. Different economies require different solutions, and central banks must tailor their policies to local realities. The divergence between the Fed and the Bank of England is driving currency moves. It's a reminder that global pressures play out differently in each country. In Asia, the Bank of Japan is also holding its ground, keeping rates at 0.5%. After years of ultra-low rates to fight deflation, Japan is finally seeing modest inflation and wage growth. The central bank is cautious, waiting to see if these trends last before making changes. Political uncertainty, with a new prime minister on the horizon, adds another layer of caution. The Bank of Japan's steady policy contrasts with the Fed's expected cut, making the yen more attractive to investors. When U.S. rates fall and Japan's hold firm, global money shifts toward the yen. Currency values reflect these diverging economic realities and policy paths. The world's major economies are not moving in lockstep. So what does all this mean for you? If the Fed cuts rates, borrowing could get cheaper. Think lower payments on credit cards, car loans, and mortgages. But savers may see lower returns on savings accounts and CDs, making it harder to grow cash reserves. A weaker dollar means imported goods, from cars to electronics, could get pricier over time. On the flip side, U.S. companies that export may benefit as their products become more competitive abroad. Planning a trip overseas? Your dollars won't go as far, making travel more expensive. These changes may not happen overnight, but they ripple through daily life. The Fed's decisions in Washington have global reach, shaping how we borrow, save, shop, and travel. Staying informed helps you make smarter financial choices. The story of the dollar's decline is really a story about all of us.